Ladies and gentlemen, good day and welcome to Pitti Engineering's Q1 FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions at the end of today's presentation. Please note that this conference is being recorded. Before we begin, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. For a list of such considerations, please refer to the earnings presentation. I would now like to hand the call over to Mr. Pitti. Thank you, and over to you, sir.
Good evening and welcome to our Q1 FY23 earnings call. I'm delighted to inform you that the company has achieved the highest ever sales both in terms of quantity and revenue. Sales grew by 42.32% to 8,747 metric tons, bringing in a total revenue of rupees 311 crores, registering a growth of 76.90% year over year. Renewable energy, special purpose motors, mining and railway related businesses continue to outperform our other end user segments. Blended sale realization during the quarter stood at rupees 3,55,000 rupees per metric ton. EBITDA was rupees 40,539 rupees per metric ton. Year over year, EBITDA grew by 26.8% to rupees 35.5 crores. Net profit was up by 59.1% to rupees 11.71 crores. Order book and forecast as of June 30th, 2022 was 948 crores. Our ongoing capex is on track, and during the quarter we added an annualized capacity of 4,200 metric ton for sheet metal. Capacity utilization during the quarter for sheet metal was a healthy 73.62%. Machining capacity utilization came in at 79.1%. I would now like to open the floor for Q&A session.
Thank you very much, sir. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Balasubramaniam from Arihant Capital. Please go ahead.
Good evening, sir. Congratulations for a good set of numbers. My first question is, the current capacity stood at 50,200 tons per annum. Previous call mentioned about 72,000 tons per annum is expected to complete by FY23. If we move around 7,000 tons per annum, 7,000 tons per quarter by next 3 quarters, then only we can able to achieve. Any comment on that?
We cannot increase our capacity in a modular manner beyond a point. Right now, the floor space in our factories are saturated and we are undergoing civil works. Once it is completed, the rest of the entire capacity will come in a single shot towards March of 23, not quarterly.
Okay, sir. Okay, got it. The order book stood at 948 crore in Q1 FY23. Could you please share the breakup and executable time frame?
The short-term order book is about 700 crores, which is executable within the current fiscal year. The residual is long-term.
Okay, sir, got it. And the raw material costs are impacted the whole industry. Every player are facing some lag on passing the raw material cost. Right now, commodity prices are cooling down. We may expect margin recovery from Q3 FY23 onwards. Any comment on that?
See, if you see from quarter 4 to quarter 1, our margins are flattish, and as you know, the entire raw material cost is passed through on a quarterly basis to our clients. With the cooling raw material prices, there will be no change in the pass-through mechanisms and therefore no improvement to margin.
Okay, sir. Sir, we commenced supplies to automotive industry. What kind of products supplied and what kind of future opportunities we have right now?
So for the automotive industry, we are now supplying to both the segments of automotive, internal combustion engine as well as the electric vehicle. These are now commercial supplies which have commenced from this quarter, and we expect the revenue growth to pick up from quarter 3 onwards.
Okay, sir. So how much capex spend on current quarter, and what kind of capex for next 3 quarters?
So current quarter we have spent 30 crores, and over the next 3 quarters we expect to finish our balance budget, taking it to a total of 270 crores.
Okay, sir. So what is the maximum peak debt levels in FY23?
As I had mentioned earlier, we are targeting 350 crores to 375 crores of peak debt, not more than that.
Okay, thank you, sir. That's it from my side.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Piyush Jain, an individual investor. Please go ahead.
Hello.
Yes.
Hello, am I audible?
Yes.
Yeah. I just want to know, because the earlier participant also asked the reason for decline in margin. Is it an input cost?
No, if you see quarter on quarter, there's no decline in margin. If you see year over year, there's a reduction in EBITDA per ton, and that is mainly to do with the cash discounts passed on to our clients to reduce our overall working capital cycle. Over the last 2 years, we've reduced our working capital cycles from approximately 180 days to mere 90 days.
So what is the EBITDA margin level we foresee for a year 23 or 24? Or maybe EBITDA per ton? Because last quarter it was 45,000 EBITDA per ton. Now the number is around 40,000.
Last quarter, you mean for FY20?
Q4, yeah. Q4 FY21. I'm comparing with Q4.
If you compare to Q4, it is 40,000 only. It's around 40,000 in Q4 22.
Sorry. YOY basis.
Yes, so YOY, that's what I was trying to explain to you, that the reduction has come on account of improving our working capital cycle, wherein we have passed on cash discounts to customers for better payment days. And we expect this trend to continue at 40,000 level for the current year.
So the EBITDA margin, we think we'll be able to achieve around 12 to 13% or it's 11% range, which we achieved in Q1.
See, we are more confident in saying EBITDA per ton because as a percentage, it will vary depending on commodity prices. In percentage terms, it should improve going forward as the commodity prices will fall and EBITDA will remain constant at a per ton level.
Okay. Coming to this automotive side, which we just started in current quarter. So what is the aspiration? What type of volume or business amount we can do in next 2 years in 23 and 24? And can we get to know to which customers we are selling?
Customer-wise, I can only say that there are a couple of customers in the two-wheeler space based out of Maharashtra and South India. I can't disclose more than that. And apart from that, we're supplying to electric bus requirements in South India. As an aspiration, this is a sector that we are very bullish on over the next 2 to 3 years. We see it maturing as the EV adoption in India picks up. We see good opportunities coming from this segment.
Okay. And sir, current the 270 crore capex, currently we have only planned this capex only, correct? There is no other capex which we are thinking right now?
So this 270 crore capex will end by FY23. And after that, we may take up a modernization program for our Hyderabad facility, as I had mentioned in the last call.
Okay. Sir, just last question. On the overall volume-wise, the metric ton of around we achieved in quarter 8,700. So with the current capacity and the capacity which will be increasing in current year, what is the maximum peak optimum level we can achieve on a capacity side?
See, peak optimum capacity in our industry is about 80% of the installed base.
Correct.
So this year we are targeting to do 40,000 tons. No, so now the capacity will come in only in March 23. So for the current year, our target is 40,000 tons, and the installed capacity as of now is sufficient to meet our current year requirements.
And for with new capacity coming 23, what can be the target for 24?
For 24, we have laid out a target of 50,000 tons, 48 to 50,000 tons.
Okay. Thank you from my side.
Thank you. The next question is from the line of Shivang Joshi from Centrum PMS. Please go ahead.
Hello. Good afternoon, sir. Thank you for taking my question, and congratulations on a decent set of numbers. I hope I'm audible.
Yeah, you're audible. Please go ahead.
First, I would like to understand how do we expect the volume trajectory to be going ahead? I mean,
Shivang, again, your voice is muffled. We cannot hear you.
My first question is on the volume front. We have seen roughly 8,600, 8,700 metric tons of volumes since last 4 quarters now. So when do we expect this volumes to inch to the next level, considering the fact that we've already added capacity over the last 3-4 quarters?
So we expect quarter 2 to be flattish around 9,000, 9,100 tons. And quarter 3 onwards, we expect to go to 11,000 and then to about 11,500, meeting our annual target of 40,000.
Okay. So currently we are aiming for a 40,000 mark, at least for FY23. And okay. And how would that go in FY24? Basis the traction that you must be seeing in the order book or the order inflows or the demand momentum that you are seeing? Because in FY24 we'll have large part of the capacity online, as you mentioned. By
FY24 we are looking at 48 to 50,000 tons.
Okay. Yes. Also, moving on to the next part, that is the EBITDA per ton. It is fairly maintained in the range, as we can see, 40 to 41,000 since again last 4 quarters. We actually wanted to understand, if I just try and have a look at your machining capacity, which actually moved from 360,000 hours to 4 lakh hours, whereas just taking a multiplying factor of utilization, we have not seen a very high utilization in the machining capacity as of now compared to the sheet metal capacity, which moved from 36 to 50,000, and the volume have also grown. So 2 questions primarily. When do we expect machining capacity to come online, whether it will be modular again Q2, Q3, Q4, or again it will be back-ended? And
so now it will be all back-ended. We have no space to put any additional machines till the civil work is done. So all the capacity will be coming in together.
Okay. And consequently, when do we expect an inch up in my EBITDA per ton?
So the improvement in EBITDA per ton will come once the new machining capacity comes, commensurate to the sheet metal capacity and start getting utilized. If you see, machining capacity is now at about roughly 80% utilization for quarter 1 FY23, which is the optimum utilization. Beyond that, it is not recommended to utilize the capacity, and it's not feasible also with the product mixes changing.
So for both sheet metal and, just from my understanding, sheet metal and machining, both capacity optimal utilization level will be 80%.
Right.
Okay. Thank you, sir. I'll come back in the queue for further questions. Thank you for answering that. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Manan Shah from Moneybee Investment. Please go ahead.
Yeah, hi. Thank you for the opportunity. If I look at our realization per ton, so on a sequential basis, they have increased by roughly around 23,000 rupees per ton. And when I look at our COGS per ton, they have roughly increased by 33,000 rupees per ton. So there has been a shortfall of roughly 10,000 per ton in passing on of this increase in raw materials. If you can just comment on the same.
Come again, I couldn't understand that. You mean cost of materials?
The realizations for the company for Q1 came in at roughly 3,55,000 as against 3,31,000 last quarter. So there is an increase of roughly 23,000 rupees per ton.
Okay.
In a similar way, the COGS, the material cost per ton, came in at 2,64,000 versus 2,30,000. So there is an increase of 33,000 in the COGS, while the realizations increased only by 23,000 per ton.
So you mean in cost of goods sold? So that
Yeah,
is
cost of goods sold.
also, yeah, so that is also because of the forex loss and gain that we book. If you see the other expenses during the quarter have shot up dramatically when compared to sequential or year-over-year basis. As the dollar has been volatile, all of our currency positions being hedged, we have to take a mark-to-market loss on those contracts, which are booked in other expenses. So if you see cost of materials consumed, we have passed on everything.
Okay. No, because the increase in the cost of material consumed comes to approx 33,000 rupees per ton. However, the increase in the realization per ton comes to only 23,000. So there is a shortfall of roughly 10,000 rupees per ton in terms of pass on, is what I could see.
Let me just check that once.
Yeah, sure. And what sort of incentives would we be getting for this year?
Just hold on for 1 second.
Yeah.
Yeah, for incentive for this year, we are expecting to book 27 crores, which will be towards Q3 or Q4, based on last year's sales.
Okay. And for the capex for the modernization and increasing of our machining capacity, how do we plan to finance the same?
That we plan to finance entirely through internal accruals, as that will be done through FY24 and 25.
Okay, fair enough. Thank you. I'll come back in the queue.
Thank you. The next question is from the line of Nikhil Chaudhary from Chris PMS. Please go ahead.
Yeah, hi sir. Good evening and thank you for the opportunity. Sir, I couldn't understand. You said improvement in EBITDA per ton would be coming will be coming towards the end. Like, what was the reason that you alluded? Like, I couldn't understand.
So the machining capacity will come towards the end of current fiscal year. As the machining capacity will come, the blended EBITDA will improve. The blended EBITDA is the blended EBITDA for lamination as well as machined and value-added components put together. So if the volume of lamination increases without a commensurate increase in machining capacity and its utilization, the blended EBITDA per metric ton would come down, right?
Understood. Okay. So what is that blended EBITDA? Probably, I guess you have alluded in the earlier Concall, but something that is in the ballpark range of 45,000, if I'm right.
Yes. Once the machining capacity fully comes online and gets utilized, we are expecting about 45,000 EBITDA per ton.
Oh, understood. Also, sir, probably what has been probably the demand outlook that has been traversed in the last 2 or 3 months after whatever we have witnessed globally? Like, is there something that drastic shift that we are witnessing, or is it something that the other countries also considering taking from us or something like that? Wanted to understand on that front.
So the local demand scenario has remained strong, and the export demand as well as deemed export demands are also improving. If you see our end customers such as Cummins ABB, who have published the results recently, their exports and other revenue also is going up dramatically. And we are seeing the same thing trickling down to us in terms of business.
Understood. Okay, cool, sir. Thank you so much, and that's it from my side. Wish you all the best.
Thank you. The next question is from the line of Pulkit Singhal from Dalmus Capital. Please go ahead.
Thank you for the opportunity. The sales volume just hasn't gone up in the last 4 quarters, and even from your guidance, even the second quarter of this year may not be that great. I mean, 9100. But so what is really happening there? I mean, you had an order book very much in place, but it's not really translating to volumes. So what has been the reason for delays? Has there been any cancellation by any of the existing customers or any postponement, if not cancellation?
There's no postponement or cancellation. If you see our capacity of 50,000 tons annualized capacity has come in only this quarter. And without that in place, it was not really possible to increase our sales in any dramatic fashion. If you see, quarter four, our capacity was 46,000 tons, and our capacity utilization was still healthy. So now with the capacity coming in, our sales will go up in quantitative terms. For quarter two, we are not forecasting a dramatic increase in volume, as the commodity prices are easing out and the supply chains are being kind of eased out by our clients who had loaded a lot of inventory. They are now liquidating the inventory. So for one quarter, we are being cautious. From quarter three onwards, we are expecting significant volume growth.
Okay, so there has been a kind of one quarter kind of impact because of this inventory liquidation kind of aspect, maybe.
That's what
in terms of timing.
Expecting. I mean, yeah, we are just seeing that kind of a trend right now, which we expect will last for this quarter. I may be wrong. It will start improving probably from this month or next month onwards. But I don't see it lasting more than a quarter, that trend.
Okay, sure. Also, in terms of this, the EBITDA per ton, I mean, I understand machining capacity helps improve the EBITDA per ton. But then, there is also, I mean, within the core laminations also, you have a commoditized bit and you have, somewhat much more value-added bit, etc. And typically, one would have expected that shift to also add to an EBITDA per ton. But your growth does not seem to be happening at the value end. So if I look at volume growth is 42%, but EBITDA per ton decline is minus 11%. So why is that the case?
See, there are two reasons. Firstly, if you go to the value add bit of the lamination, the value add comes from the machining. Machining is the process through which either we integrate a shaft or a casted frame into the lamination product. And that has to increase in terms of capacity as well as its utilization. The second, which I had mentioned, to improve our working capital cycle, we have offered cash discounts to our clients, thereby reducing our sale realization and reducing our interest cost.
Right. So if you could help us understand sales realization and interest cost, right? Both.
So
hello.
If you take a sales realization in FY22, Q1 FY22, there was sales realization was 285,000. Now in that we have given a cash discount, and that has come off our top line in the current quarter. If you compare the same thing.
Understood. So this part, because the benefit is accruing more so on the balance sheet here.
Yes.
Yeah. So and we did see an improvement of debtor days from 110 to 72 days in FY22, right? I mean, so is the impact that we are currently seeing still reflective of that benefit which is already captured in the balance sheet, or there is more benefit which will accrue this year in terms of days?
No, there is no more benefit which will accrue in terms of days, as in our export cycle or the export side of our business, we cannot do that as efficiently as we can do in the domestic. The transit times remain the same, so that base effect will still be there. So the debtor days outstanding will not improve beyond 70 to 60 days going forward.
Beyond 72 days. So your working cycle was, net working capital cycle was around 92 days, of which 72 was due to debtors. So are we saying there's not much scope for improvement within the 92 days itself, or there could be some improvement on inventory and creditors?
In inventory and creditors, there are definitely improvements, and the total working capital cycle as on June is at 78 days already.
And you expect the 78 to continue? So, is this because of seasonality, or do you think the 78 will continue even till end of the year?
We have improved our payable days, and now we are further rationalizing our inventory days. So we expect the 78 days to improve about 70 days in the short term, and then going forward even more.
Right. And as you think about 3-year growth, obviously you have certain volume growth plans, etc. The question really is, on the EBITDA per ton, right? You can grow at whichever end of the spectrum, or commoditized spectrum, or somewhere there in between. But as you're seeing things pan out right now, what kind of EBITDA per ton do you kind of think should it settle at 3 years out?
3 years out, with all the capacities in place, both in machining and sheet metal, and optimum utilization on both, we expect the EBITDA per ton to be about 45,000. And that is to be seen in the color of the debtor days and the total working capital cycle. because we will be sacrificing a little bit on the EBITDA per ton to further improve our balance sheet side. So we target our working capital cycle to be down to about 60 days, 3 years from now, and give you a EBITDA of about 45,000. At least that is the thinking.
Understood. Okay. And there any change in the demand environment that you might want to call out on the positive or negative side?
See, on the positive side, for long-term orders and new projects and models which are being developed by our clients, we are seeing a healthy flow of new inquiries. In terms of order execution, like I said, this quarter, the expected growth for Q2 is not there. The reason that our clients are giving us is that due to the easing out of the supply chain situation, they are kind of leveling out the inventories which had ballooned. And from quarter 3 onwards, we should be back on track. The long-term side, it's been quite bullish, especially in the machine components business. And that we think is going to grow exponentially in the coming years.
And the reason for that?
I think better adoption of more value-added and assembled products at our client level.
Okay. Got it. Thank you, and all the best.
Thanks.
Thank you. The next question is from the line of Sanjeev Zarbade from Dream Ladder Investment. Please go ahead.
Thank you, sir, for taking my question. My first question is, how is the replacement market for railways shaping up, sir?
The business that we do with Indian Railways till now has primarily been through Wabtec and Alstom, and those are new locomotives, so the replacement market has not really started for it in any significant way. We are right now getting approved for a whole host of products for direct supply to Indian Railways, and there the replacement market is quite big.
Okay. And sir, secondly, where do you stand on supply of gearboxes to railways?
So we don't supply the gearbox. We supply the casing of the gearbox, which is the outer protective cover. That is one product in which we have approved ourselves not only for Wabtec and Alstom, but also now directly for Indian Railways. And those kind of products typically have a much higher replacement market than the overall locomotives, as those get worn out and replaced very frequently.
Okay. And sir, regarding on the quarterly results, there has been a reduction on a quarter-on-quarter basis in interest costs. So has there been any reduction in our borrowings in the last quarter?
The borrowings have gone up on an absolute level as the capex is still ongoing. But in terms of working capital deployment, as I had mentioned earlier, we have improved our total working capital cycle in this duration. That is one of the reasons the interest cost has come down. Apart from that, the debt rating was upgraded of the company last year in sometime around October. So consequent to the rating upgrade, we have renegotiated the spread over the benchmark rates with our bankers, and that benefit is now seen in the P&L.
Okay. And sir, as you've been kind of signaling regarding the clients going for inventory rundown, so does it appear then that your September ending quarter in terms of revenues will be lower than the June ending quarter in terms of revenue?
See, in terms of quantity, we are still saying that the overall quantity will be higher than quarter 1 for September quarter. In terms of revenue, it will be lower not because of inventory rationalization, but because of the decrease in steel prices. Specific to our industry, the electrical steel prices have corrected by about 16,500 rupees per metric ton in the last in July, 1st of July, and that has been passed on to the clients. So the selling price has come down. If you see the order book also has come down vis-a-vis 31st March. That's because of the revaluation of the orders at the new price point.
Okay. Okay, great, sir. That's it from my side, and all the best.
Thank you.
Thank you. The next question is from the line of Manan Shah from Moneybee Investment Advisors. Please go ahead.
Yeah, hi. Thanks for the follow-up. So, since our machining capacity will take some time to come online from here onwards, however, our sheet metal capacity will expand, then where do you see the EBITDA per ton going in that case, since the mix would change and we would not be able to, have a similar mix between machining and the sheet metal components?
In the short term, we see the EBITDA being around 40,000 for the current year. By the end of the current year, we expect the machining capacity to come in. So we see the EBITDA starting to improve from FY24, and by FY25, when both the capacities of sheet metal and machining will be optimally utilized, we see it going up to 45,000.
Okay. Okay, thank you.
Thank you. The next question is from the line of Ravindra Naik from Sunidhi Securities. Please go ahead.
Hello. Sir, thank you for the opportunity. Sir, whether we have received the incentives of last year?
For last year incentive, typically it takes about 6 months for the money to be disbursed by the government, and the letter had come in April, so we expect the collection to happen sometime in October.
Okay. Okay. And sir, you are catering to at least 9 industry groups currently, if I see the presentation. So, which industry will contribute to the EBITDA spike post commissioning of the capex? And what is your guidance for FY23 EBITDA per ton post commissioning of the capex? And why this EBITDA will which industry will contribute to maximum EBITDA going ahead in FY23-24?
See, there's no industry per se that contributes higher EBITDA per ton. It is the level of value add and the complexity of product that we supply. We supply the highest complex products to the railway industry today. That is because that's the way the product is configured for them at the initial stage of development itself. Apart from that, renewable energy is another place where we do significant amount of value add, as is the data center backup power systems. Now the trend of higher value added products is picking up across special purpose motors as well as industrial motors segment. So as you do the value add, your EBITDA per ton increases.
That I understand. That I understand. But which industry is providing you an opportunity for higher value add? Among all the 9 group of industries that we have mentioned, which industry group is actually contributing the significant value add opportunity to you?
So railways gives us the highest value add, because there we do a lot of machine assembly of the product, as is renewable energy and data center backup power systems.
Okay. And sir, what is the average realization currently? The last delivery. If you can mention that.
I didn't understand the question. Can you please repeat that?
Last delivery realization, average realization per ton.
So for the blended realization is about 3,55,000 for quarter 1 FY23.
No, I am talking about in the current quarter. What is the blended realization for the last delivery?
See, that is going to be changing month to month depending on the product mix. We cannot kind of quantify that mid-quarter.
Okay. But any idea, because you have mentioned that the commodity prices corrected. So how should we see the EBITDA per ton in the second quarter? Any ballpark figure?
See, the EBITDA per ton will not be impacted due to correction of raw material price.
Realization per ton. Sorry.
So the industry thumb rule is the raw material consumption factor is 1.8, and the steel prices are corrected by about 16,000. So that should give you an impact of roughly 28,000 rupees per ton in terms of blended sale realization, typically.
Okay.
But again, that will change depending on the product mix, the grade used, the level of value add. There are so many other factors which impact that. It's not just the raw material pricing.
Okay. So your order book is priced to the current commodity prices?
Correct. The order book as on 30th June is priced to the current raw material prices.
Okay. What is that? It is 900. Can you please?
948 crores.
Okay. Thank you very much. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Piyush Jain, from an individual investor. Please go ahead.
Sir, I want to know, are we doing still some 100 crore business with Pitti Casting, a group entity?
Yes, we should be doing about 80 to 100 crores of top line with them even today. All of our casting, the majority of our casting comes from there.
Sir, any plan to merge that entity? Because sometime on a related party, some type of sales, sometimes it shows that why the business is happening in that entity. Is it because of that some particular specific feature is there in that entity which is not in under Pitti?
So this was not a business which was an entity of Pitti. It was a company that we bought out in our individual capacity who was supplying to us, and we had a strategic stake in the business. Over the years, we felt that to control the supply chain, as most of our clients would like the qualifications and the control on the incoming product be in the group, we had bought it under the group. We have plans to kind of consolidate this industry, at least that's our intent. We couldn't proceed with the intent because there's an open offer which was pending since 2011, which was contested by SEBI all the way to Supreme Court. Now that the resolution has come on that open offer, it will be done away with shortly. And once that is done, then we can work out a process to kind of amalgamate these two companies if permitted by the board.
Okay. Sir, another one question. Do we have any ICD still there in from the promoter in the balance sheet?
Yes, 25 crores is subordinated to the term loans of the bank. And apart from that, for short-term needs, I do keep giving them. I think as on 30th of June, the ICD in Pitti Engineering is about 40 crores from the promoters, including the subordinated portion.
Okay. And the last thing, since you are saying based on the discount, your working capital days are coming down. So what could be our working capital peak debt, which you are envisaging for 23?
Working capital peak debt, that should come down to about 200 debt.
Working capital debt.
Working capital alone should be about 190. Should come down to about 190.
Should come down to 190 for 2023.
Yes. At the end of 2023.
Okay. And the incentive with respect to this plant will come in the March only, right? March 23.
The process, just to give you an idea, the process to apply for the incentive annual report also be submitted and the GST audit. So once we receive that, only then we can apply for FY22, the application with the government. Typically, it takes about 6 months for them to release it.
So historically, it has come always in the March month. So in the current year also it will come March, or it can come before that also?
See, the minute we file it, about 6 months is what it takes. Once the annual report is out, say in September, we file it, we typically get it in March or April, 6 to 7 months max.
And what is the quantum for next 2 years?
It will be flattish at 32 crores for next year. Current year would be 27 crores. Next year should be about 32 crores. The sanction process also is typical. About 75% is sanctioned based on self-declaration. Another 15% is sanctioned upon scrutiny, and then another 10% on GST return for audit. So there's a kind of a ruling sanction on that.
Okay. Sir, last thing. Currently, we are having an order book around 950 odd crores. So what is your view with respect to the order book which you can achieve for 2023 to be executed in 2024, and the turnover size? Like 2022, we have achieved a 950 crore. So what is the peak size you can envisage now, or even a 2-year or 3-year horizon?
I would then want to comment on that using the Q1 raw material prices, because otherwise it will not be a fair comparison. We have done 311 crores of revenue for Q1. If the same prices continue, then for the full year we should be heading towards about 1,350 crores of revenue. Obviously, that's not going to be achievable because these commodity prices have already started declining.
Okay.
So that's why we like to always put the quantitative data out there on the tonnage side, because that is the kind of a steady barometer which does not get affected by the commodity fluctuations.
But still maintaining the whatever level of 2021 and before that the high commodity price. Still, what can be the target? I think somewhere 1 or 2 Concall back we have told some 1,800 crore of revenue in 2024, if I remember correctly.
See, on the same raw material prices, if they are there, then yes, 1,800 crores would be the kind of a target revenue.
For 24, correct?
Yeah. If you take my guidance on 48 to 50,000 tons of total tonnage sold and take the 355,000 sale realization, you get to about that number.
Okay, perfect. Perfect, sir. That's it from my side.
Thank you. The next question is from the line of Bala Subramaniam from Arihant Capital. Please go ahead.
Thank you so much, sir, for taking my question again. Sir, that revenue potential of 95 crore per annum from various machine components for off-highway applications and locomotive applications and other machined parts for locomotives, which is expected to start from H2 FY23. Any comment on that?
That is on track. The products are under approval stage. We have supplied the protos and got the initial approval in Q4. The pilot lots have been supplied, and we expect to start commercial supplies from Q3 onwards, and the volumes will pick up from Q4 onwards.
Okay, sir. Sir, you are using steel as your main raw material. Like what kind of grades you are using? If you could give the breakup for that.
There's no breakup per se. It is based on the customer specification. We do not decide the steel that we use. Basic commodity spread would be electrical steel. Within steel, there would be electrical steel. There would be different kinds of alloy steels for our shafts and other kind of child part materials, and of course castings of various grades, including iron and steel.
Okay, sir. Got it. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Neeraj Mansingha from White Pine Investment. Please go ahead.
Yeah, I just wanted to know on the railway, can you give us more color on how things can scale up in next 1 year and next 3-4 years, and how the scale up of the Vande Mataram and all that can you participate in that?
I'm sorry, but you're not audible. Can you please repeat your question more clearly?
Yeah, I just wanted to know on the railway side, can you please help us understand slightly longer perspective what are your thought processes and how to scale up when the capex of Indian Railways comes up? What role would you play during that time? And slightly more longer term understanding would be useful.
So if you say railways, it's a very wide spectrum. So we like to break it down into multiple parts. So one is on the freight rail. If you take the freight rail, there's the diesel locomotive and the electric freight locomotives. On both of those platforms, which are being supplied by Alstom and Wabtec, we are the qualified supplier for many products. And we see that business being steady as it's a 10-year fixed contract on volume per year. Additional to that, there are various announcements by the government on different kinds of electric freight loco, which they plan to make within their own facilities, as well as some of them which will be outsourced in terms of design and development. We are participating with most of the people who are bidding on those projects on the freight loco side. On the passenger loco side, Indian Railways is currently making most of their locomotives in-house, and over the last 2 years, we have gotten various levels of approvals for a lot of components. Commercial supplies, depending on the railway's own validation matrix, takes a long time. We have to supply the first set of protos and wait for a year for the feedback to come from the field, and then again supply the pilot lots, have a similar waiting time, and then the commercial supplies start. So we see the commercial supplies for direct to rail Indian Railways supplies starting from FY24 onwards for these gear cases as well as axle boxes and suspension tubes and those kind of machine components. And that's a big business opportunity. Apart from that, we are working with various sub-vendors of railways for the Train 18. As of today, only Medha Servo Drive is the approved supplier for those traction motor related components. Alstom, CG Power, and various other people are getting approvals, and we are working with them as well. Then you have RRTS side of the business on the Indian Railways, which is in a nascent stage of development. So it's a very wide field, and we are working with various companies on all of those fields. There's Metro Rail as well, which will not be covered in the railways directly, but kind of rail-based commuting systems. Overall, we see that railway and railway-related businesses should contribute even higher percentage of revenues going forward.
Okay, got it. Thank you very much.
Thank you. Ladies and gentlemen, as there are no further questions, on behalf of Pitti Engineering, thank you all for joining the call. For any further information and plant visits, please be in touch with Mr. Rama Naidu from Intellect IR. That concludes this conference call for today. Thank you all for joining us, and you may now disconnect your lines. Thank you.